Hey everybody, this is my favorite video series I do every single month where I talk about my favorite stocks in the market right now. And this is the May 2023 edition. In fact, there are 6 different stocks in the market right now that I really like that have some really good value right now. And this is the first video you watched of mine. My name is Justin. I am a value investor, so I do follow investors such as like Howard Marks, Monish Pabrai, Warren Buffett, David Tepper. I even took Phil Town's investing course a couple of years ago, and I learned a lot from the investing course and his books as well. So I try to tailor a lot of my investing strategy after what Phil Town talks about. So without further ado, let's jump into this first stock. All right, here we go. First stock up I want to talk about, and I've talked about this stock a ton on this channel over the last year, and that is Douglas Emmett, ticker symbol DEI. This is a REIT, and you can see over the last year, the stock is down about 56%. So it has completely dropped from almost $35 a share, and right now it's trading around $12 a share. Now, REITs in general, in my opinion, are really undervalued across the globe at this point. Now, I specifically like Douglas Emmett for a couple reasons. One, they are very centralized, or they're just in really just 2 different markets, and that is it. So they're in Honolulu, Hawaii, and they're also in Los Angeles, California. Those are 2 of the top 5 GDP grossing cities in the entire world. And specifically LA, it's almost 70% of their entire portfolio is there. And in LA, it's already built out. So they don't have, really concern about other competition coming in and building a building right next door. There's not much to build in LA. It kind of is what it is. And so I think they're in a really good market and a really good spot in both those markets. And I think right now, it's trading at a very, very good valuation overall. In fact, look at a book value per share, and that is one way you can possibly value a REIT on a historical basis. If you look over the last 10 years, Douglas Emmett is trading at the lowest it has ever traded at. I mean, right now it's trading below a 1 for a book value per share, and on average it's traded over a 2. So just from that metric alone, it looks like you're talking 55 to 60% margin of safety right there. So I do like where it's at right now. And I don't mind actually continuing to add to my current position because I think it is in a good spot as is. All right. So next up, let's talk about stock number 2, Great Lakes Dredge and Dock, ticker symbol GLDD. Now, this is the first time I've talked about this stock on this channel. It is a micro cap stock. The stock is down 58% over the last year. It was around 15. Today it's trading below $6 a share. So this is a dredging company. And you might be asking, what the heck is a dredging company? Well, it is a company that owns a bunch of different large vessels. And essentially what they're doing is they're moving sand from the ocean from one place to another. They might be taking sand from the bottom of the ocean, pushing it to the shore. They're essentially deepening ports. They might be expanding ports. They could be doing restoration along the coastal areas. They do work mainly in the United States, but they are the only United States dredging company that does stuff international as well. And this is an oligopoly type industry. So there's only a few players in there. They are the largest player in this space. They've been around for almost 140 years, and their number one customer is the government. But 2022 was the worst possible year that they could have had. So if you look at 2021 to 2022, revenue only dipped about $75 million, but look at gross profit. It dipped from 21% margin down to 5%. So what's happened with this company is they have a ton of fixed costs. So they have these huge vessels. They have a lot of these fixed costs. And so even, small variance of revenue movement can have a massive impact on the bottom line. I also spent a lot of money on new ships that are being built right now. And in my personal opinion, 2022 couldn't have gone any worse. I mean, their backlog has dropped from 700 million down to 300 million, which is completely scaring the market across the board. But what's interesting to me, like I said, the government's our number one customer, U.S. Army Corps of Engineers. So that is a majority of their revenue, and they just announced the largest budget ever, $8.66 billion for U.S. Army Corps for 2023, and $2.3 billion of that is going to maintenance and modernization of waterways. So that a lot of that money is going to be going to this specific industry. So how I am looking at them right now is a couple of things. So from a book value per share, this is about the lowest they have been over the last 10 years. So historically, they've been around 1.8 to a 2. Right now, they're just at a 1. But if they can, get their revenue back up to over $700 million, they should be able to capture between 15 and 20% gross margins, and then that should flow down and get around 60 to 80 cents earnings per share. They can do that. Their stock should be worth around $10 to $12. So that's almost a double from today. But in order to do that, I think they need to capture probably around 200 to 250 million of a backlog in this first half of the year. Probably closer to 200 million would be fine. They've already earned almost 150 so far. I think it's the back half of the year where they're expecting the most wins on projects. And so I like to see them being that $400 million mark in that second half. So that should get them to 600 million for the year. And even better if they can even get that up to 500 million in the last half, being around 700 million. That should really pump up their backlog overall. And I think that is coming. It's speculation, but that's kind of my thought overall on Great Lakes Dredge and Dock. Next up is Sitio Royalties, ticker symbol STR. Stock has kind of been all over the place. So this is a company that actually acquired another company in 2022. So it was a new ticker symbol. It's essentially a company that is in the oil and gas industry. It's not an operator. They own oil and gas rights, mostly in the Permian Basin. So this is kind of a different play. Instead of going to an operator, I'm just going right to a company that has different royalties. And like I said, they're mainly in the Permian Basin. So this is just my play on oil and gas. And also, oil and gas companies tend to do well when inflation is going up. So it's a hedge against inflation from my point of view overall. Now, from a valuation standpoint, how I'm looking at them is I think they should be able to grow 13% on the top line over the next 5 years. I think this year they should have a lot of growth, 20, 25%. Seems very, very reasonable. Operating margins were around 63% last year. I kind of sandbagged their operating margins going forward to 45%. I think it's going to be higher than that. And with just a standard multiple of 16, it gives me an intrinsic share price of $33. That's around 25% margin of safety. I would like to see the stock being really closer to $20 than 25. For me personally, if it gets down to 20, I'll be buying more. It's a stock that right now pays a 10% dividend, but it's all going to be tied to oil and gas. So if as long as oil is doing well, the stock should do very well as well. And if you're curious on how to value companies, I do offer that on my Patreon. You also get access to my Discord channel as well. I offer, I think, like 3 different valuation templates on my Patreon. So I'll put a link down below if you want to go check that out. And if you're interested there. All right, stock number 4 is Celanese, your symbol CE. I've talked about this stock quite a bit on the channel, but it's been a while. The stock has dipped here in the last month to, I think, a decent buy price. So it has dropped around 25% over the last year. I mean, it was around 160 at one point. Right now, it's just a little over $100 roughly. This is a company that you probably use their products and don't even know. So they're actually one of their biggest revenue drivers is acetic acid, formaldehyde, nylon compounds, ketones. So this is essentially different, chemicals that they make or material that they make that go into products. So a lot of the clothes that you wear probably have their products in them. One thing I think that is really shaping this business is that they're going really strong into the polymer business. And I think it's one of the reasons why their stock has fallen. So they announced last year they were buying DuPont's polymer business for over $10 billion, which scared a lot of folks. But it should bring in around $900 million of EBITDA roughly going forward, which should be around roughly $500 to $600 million of operating income from what I calculate out. So I think it's expensive a little bit up front, but I think long term it's going to bring a lot of synergies and cost efficiencies to the business, and that's what they talked about. They're going to be more cost efficient than even what DuPont was, which should help the bottom line. So from a valuation standpoint, they're going to have a huge growth in 2023 from 9 billion to about 13.5 billion, 50% growth because of that acquisition in 2022. So I think a 15% growth on the top line roughly over the next 5 years on average. I think their operating margins, right now, last year was around 17. I could see it getting to 17, kind of sandbagging it, just because I think it's going to take a while to get the companies kind of harmonized and getting those cost efficiencies worked out. So I'm only saying a 15% operating margin. And based on that, I get about $187 intrinsic price for this stock, which is about a 40% margin of safety. I will notate that I have shares outstanding of 108 million. I think that ticked up to around 110 roughly right after the acquisition. So I think the share price I would get for fair value would probably be around like between 170 and 180 for the stock right now. But it definitely looks interesting. I think anything under 100 is a solid buy for this company in general. Next up is Baxter International, ticker symbol BAX. Stock is down 53% over the last year. They've been absolutely hammered. So this is a company that makes medical equipment, and they bought a company back in 2021, and there was a lot of goodwill on their balance sheet, and they ended up impairing a lot of that goodwill last year. So they had a massive amount of expenses hit the books, and it created billions of dollars worth of loss. And that really scared a lot of investors that was a bad acquisition, and then seeing that on the P&L as well. And it just scared a lot of folks. And for me personally, I think this is a good opportunity to buy in because they're trying to do a lot. This is a company that has a lot of pieces that are moving around. So they're really heavy in acquisitions. I mean, they've acquired over a dozen companies over the last several years. They're looking to spin off a piece of their business, potentially even making it go public. So a lot of stuff is going on with the company right now. It's still a very profitable business. I just think that write-off last year really scared a lot of folks, and then all the different things they're trying to do internally. Cost efficiencies and spinning off divisions. I think a lot of people are just getting away and staying away from it. But I think this is a really solid company, and I think this is a pretty good buy. In fact, from an intrinsic value standpoint, I think they're going to be flat this year for sales, but I think it's going to grow to 18 billion roughly by 2027. That's roughly a 4% growth on the top line, which is not much, but I do think their operating margins are going to be in that 17 to 18% over the next 5 years. So it's only a 5% operating income growth, but based on a multiple of 18, I think the intrinsic share price is around $70 for this company. A margin of safety is over 30%. So certainly under 40 I think is a really, really good buy. But even at 47, it seems like it's a pretty decent entry point for this. So we'll just kind of see how things kind of go on and see if those cost efficiencies and the spinoffs within the different divisions they have. But I think this is a pretty good opportunity to, buy this stock. But that's my personal opinion. Do your own research and then decide for yourself. And the last one I want to talk about is Ally Financial, ticker symbol ALLY. This is a bank around a $10 billion market cap, roughly over the last year, down 41%. A lot of the banks are just down in general. This is just a unique bank, in my personal opinion. This is a bank that is the number one digital bank in the entire world. But most people, when they look into this company, they see that they have 60% of their portfolios in car loans. And they're like, oh, I don't want to own a company that just has basically car loans. Well, the truth be told, if you dig into them, that car loan percentage of the business is going down year over year. It's gone from 80% all the way down to 60% in the last couple of years. In fact, going in 2015, it was about 100% of their business. They were spun off General Motors. So I do think their deposits keep growing quarter over quarter. When the whole collapse with the Silicon Valley Bank here recently, it took down Ally Financial. In fact, I read a couple articles saying this company's going out of business. I thought that was a complete laugh. that they thought this company would go out of business. I think they're in a really, really good position going forward. This is a bank that has, for 2022, a 20% return on tangible common equity, which is absolutely fantastic. If you know anything about banks, the big banks like Wells Fargo, Bank of America, they're in that 11 to 13% range. It did dip this last quarter. I think it was in the low teens, I want to say. But they've just been a really great company that's put money back into the shareholders' hands through dividends and buybacks. And I think that's going to continue to happen moving forward. But like I said, I think they're getting more away from the car loan business, and they're going to be more in credit cards, home loans. And I think you're going to see this bank grow faster than the large banks out there. And that's why I think that's a great company overall. As far as intrinsic value goes for this company, I'm not showing a book value per share. From a book value per share, it looks a little undervalued, but not a ton. But if I project out sales, I think sales will grow about 6% on the top line. I think operating margins should be in the 20-23% range. 6% operating income growth. I think the stock price should be worth around $40. Even today at a multiple of only an 8. I think right now they're trading on a 5 or a 6 type multiple. But I think a historical average or norm for them should be around an 8. So I think there's a decent margin of safety there overall. So that's what I think about Ally. All right, everyone. So those are the 6 stocks I was looking at for May 2023. Like I said in the video, these are just like my opinions, what I think the company is going to do. The valuations you saw, if my assumptions are not correct, the valuation is not going to be correct. I look at businesses and try to figure out what their future sales is. And then based on that, I try to also then dig in and figure out what the operating margins are. I personally like operating income when I'm looking at a business because that is kind of taking away a lot of the one-time adjustments that you might see on the P&L. And so if I can really determine what I think an operating margin is going to be, it really gives me a good idea what I think future earnings are going to be, and then discounting it back to today in order to get an intrinsic value for the stock. And if you don't know how to do that, I do teach you on my Patreon. I have a video on there and also provide templates. If you're interested, I'll put a link down in the description below. You also get access to my Discord channel, and there's about 70 to 80 of us value investors in there as well. So I'm hoping you got some value out of this. I also would love to know what stocks you are buying for May 2023. What looks undervalued to you? I would love to hear from you in the comments section. I read every single one of those. Thank you so much for watching. I'll catch you on the other side. Take care and God bless.